Warren Buffett went to sell a stock. The choice to sell a stock might be difficult. Do you sell it now that the price has increased in order to make money? Do you sell it because it has decreased so you can minimize your losses? Alternatively, perhaps you should sell it given that it has been stagnant while all of your pals are making fortunes with Bitcoin. Fortunately, Warren Buffett, the sage of securities and oracle of Omaha, has us covered on this issue. The best investor in the world has spoken on numerous times on the art of selling. You'll discover 3 real-world scenarios in this video where it makes sense to sell your stock market investments in a Warren Buffett-like manner. By the way, if all you've heard about this subject recently is what Warren Buffett has to say, you're probably doing it wrong. Let's first talk about why the character in the introduction executes his selling incorrectly before moving on to the 3 circumstances in which you should sell a stock. It's as a result of his excessive attention to the price he paid. According to Buffett, one of the crucial aspects of stocks is that the stock is unaware that you own it. You're feeling a lot about it. You can recall your price. You can recall who informed you of it. You know, all these small stuff. Furthermore, it doesn't give a damn. It simply stands there. And if, someone paid $100 for a stock at $50 and they feel awful. Someone else spent $10 and they feel great. All these emotions, yet it makes absolutely no difference. Well, so what should affect your choice to sell a stock if its price has increased, decreased, or is simply trending sideways? When Warren Buffett wishes to sell, the first scenario is as follows. When a better alternative emerges in my first 20 years of investing, if not more, I virtually always decided to sell because I had discovered something else that I was eager to purchase. In order to purchase stocks at a price of 2 times earnings, I had to sell my equities for 3 times earnings. You are aware that I enjoy discussing opportunity costs. You cannot invest the same funds in the shares of Company B after investing in Company A's shares. This occasionally forces you to make difficult choices. You might have to leave a business that you really appreciate in favor of something even better. Below is an excerpt from Buffett's 1959 letter to his partners in Buffett Partnership Limited, which he sent after leaving Commonwealth Trust to join Sanborn Map's mapping division. We sold our block of Commonwealth shares for $80 a share late in the year after finding a unique opportunity that allowed us to become the largest holder at an attractive price. I should point out that the purchaser of the stock at $80 can anticipate making a good profit over time, yet the relative undervaluation at $80 with a $135 intrinsic value is significantly different from a price of $50 with a $125 intrinsic value, and it seemed to me that our capital might be used more effectively in the circumstance that replaced it. If you followed Warren Buffett's more recent advice, this is where you might have erred in your selling. He wouldn't sell his wholly owned companies today, even if he anticipates poor investment returns. It is a little deceptive to follow the recommendation that forever is Warren Buffett's preferred holding time. He no longer holds for eternity. Rather, he prefers to value the close bonds he has been able to form with Berkshire Hathaway's subsidiary management over a few additional percentage points of return. To end relationships with individuals I admire and others who joined me in Berkshire because they believe it to be a permanent residence would be the equivalent of selling one of my children because someone waved a large check in my direction. In order to avoid disappointing my partners, I also want to let them know I won't be doing it. Although the Berkshire Hathaway Owner's Handbook was initially distributed to shareholders in a yearly letter in 1983, Buffett's method of thinking predates that year. Look at what he said in a 1968 letter of partnership. We cannot profit from owning managed firms permanently in the same way as we may from buying and selling them or from shrewd investment in marketable assets, as I have previously stated. Yet, they provide a satisfying long-term type of activity at acceptable rates of return when carried out in collaboration with high-caliber, capable personnel. After a bad experience with Dempster Mill Manufacturing in the early 1960s, Buffett started to modify his mind about buying and selling companies. A town as a whole pretty much despised Buffett for acquiring their major firm and then eliminating costs and employees to make it lucrative for a sale. Nevertheless, if we examine his 1961 partnership letter, written at a time when he was also operating with less capital, we'll find what I believe Buffett would advise those of us with smaller sums of money to do. Purchasing undervalued shares. and then selling them once the undervaluation has been addressed is our main line of business. Sonny, it's not personal. It's all about business. Warren Buffett would also offer to sell a stock in the following circumstances: when a company's economic parameters significantly alter until we become seriously discouraged with the management or feel that the economics of the company have changed. Significantly, our natural tendency is not to sell things. And yeah, that does happen. Let's examine a few past instances of significant changes that led Warren Buffett to sell. The world has altered for airlines as a result of the coronavirus, he noted in 2020 when he sold his holdings in a handful of the main airline businesses. Buffett handed off the Washington Post, one of his most significant assets ever, in 2014. Buffett discussed how the landscape for newspapers had changed for many years, and that the Post didn't have nearly the same competitive advantages. Similar to when Berkshire bought it in 1973. He finally made the decision to let it go. There is also Buffett's interest in the Tesco food chain. Buffett doesn't say why, but he had a problem with this company's management, which ultimately led to him selling his stake in the company. By 2014, he had left the job and had suffered a slight net loss. On a more personal level, if I had known about this a few years earlier, I might have been able to avoid one of my worst selling and investing errors. When I was a business owner, Kopparbergs, a Swedish beverage company, received more than half of its sales from the United Kingdom. Britain's decision to exit the EU in July 2016 made commerce with other EU nations more challenging. It may be argued that I ought to have sold then rather than later. All done, but I might mention this: seldom do fundamental changes occur. This is what Warren Buffett alludes to in his 1997 annual letter to Berkshire Hathaway shareholders when he states, "Selling great firms on scary news is usually a foolish option." Last but not least, Buffett and you know that I both support a concentrated portfolio, but there are times when you must also sell or, well, cut back. When one holding becomes too big. Certainly, it's true what they say about not putting all your eggs in one basket, but you don't have to follow it to the letter like most people would have you believe. You can invest more money in a single stock if your portfolio is smaller. Consider that in 1967, when Warren Buffett was overseeing the equivalent of $500 million in today's dollars, he invested 40% of his partnership's funds in American Express. He finally exceeded this 40% maximum rule due to the stock, so he reduced his holdings to preserve some degree of diversity. By the way, American Express ranks as Warren Buffett's fourth largest investment to date. Again, the gentleman in the video's introduction is mistaken because he is too concerned with the purchasing price. A stock could care less how much you spent for it. If I didn't already own the stock, would I still want to invest in it now? Is a good question to ponder. If not, you should probably consider selling. Although they are not exactly the same, wanting to keep a stock and wanting to buy more of it are related. Too large, sell the stock. You now understand how to sell. Here is a lengthy movie with much of information for you if you're interested in learning what Warren Buffett looks for when he buys a stock. You can read about the top 25 investments made by Warren Buffett in this article. You'll discover how these investments seemed when they were bought. Thanks, people, and I hope to see you soon.